All right, guys, we are live. Welcome to the first Bitcoin Market Insights webinar. We got a hell of a lineup. We'll get introductions out of the way shortly and then dive in. We got some of the leading, some of the leading market participants in Bitcoin, everything from commercial lending, investment funds, self-mines, hosting, mining funds, one of the largest mining pools, as well as how's it going, Josh?
Hey, how's it going? How's it going, Sam?
We're just getting started. Everyone's gonna jump into introductions, and then we'll get the ball rolling. Dennis, would you like to start?
Yeah, sure. Just a little bit background of myself. I traditionally worked in banking, project finance for 12 years. Then traditional mining, gold, copper, rare earth metals, private equity, and the last 3 years I was engaged in Bitcoin mining. So this is what we had a structure that evolved into the 80 megawatt operation facilities in Kazakhstan, and now basically we're looking to expansion in North America, Canada, and US.
Beautiful. And we got Ryan Gentry here with Multicoin. How's it going, Ryan?
Hey, doing well. Hey guys, I'm Ryan Gentry. I'm a lead analyst with Multicoin Capital. Prior life, I was an engineer at Intel, working on distributed systems and IoT type stuff. Happy to be here to talk mining.
Trevor Smith from Arctos Capital, one of the leaders in commercial lending in the Bitcoin space. How's it going, Trevor?
Going well. Hey, everyone. Excited to chat a bit more about mining and some of the finance solutions being built out in the industry today. Arctos Capital is a commercial lender based out of San Francisco and California. So looking forward to chatting further.
We got Josh Metnick here with Navier Inc. All sorts of design, implementation, both mining and other technologies. Josh, how's it going?
It's going well, Sam. Yeah, thanks for putting this together. At Navier, we essentially we help very large scale mining deployments. So it's 5, 10, 20 megawatt plus deployments, and we work with various types of companies that want to do that.
Last but not least, Alejandro Del Torre. I'm not sure if I'm saying that. De La Torre. Sorry, I always forget.
De La Torre.
No, I'm sorry.
Work for Poolin. It's a mining pool. We mine Bitcoin along with many other coins. Before Poolin, I was at BTC.com mining pool. So I have many years of experience in the pool space and been in crypto for a while. So
totally. We also got my co-founder, CEO, and very good friend, Matt D'Souza, who I'm sure you all know. Matt, want to provide a little background?
Hey, everyone. Glad all the participants that could make it, as well as the panelists. Exceptional leaders. I'm honored to be joined by these exceptional leaders. So I started in the Bitcoin, really dove into the blockchain space in 2015, early 2016. I launched a digital currency hedge fund in 2017 called Blockchain Opportunity Fund. Late 2017, we launched Blockware Solutions. That's grown to become the largest distributor of ASICs to the US market. We place miners in data centers. And we provide research. We run a Bitcoin pool. And then in late 2019, I launched another company with a partner called Blockware Mining. That's a Bitcoin mining fund. We went live January of 2020, so about 3 or 4 months ago. And the goal of that company is to bring as much hash to the US. We self-mine Bitcoin. We provide co-location services, as well as rigs for US miners to buy and get up and hashing in 48 hours. So, we've done a deep analysis on the halving, and we feel that miners need to be if they're hosting, they need to be in the high 5-cent range or low 6 range, depending on their volume. And we're getting that for them where they don't have to contribute in CapEx. So it's a hardware with hosting availability in the US. So looking forward to discussing about the halving with everyone and really diving deep into what everyone is seeing out there in the market and bringing that to our participants.
Beautiful. Thanks for the intro, guys. So yeah, obviously with halving coming up in a little under 2 weeks, hot topic conversation. Google Trends just has Bitcoin halving searches just breaking its all-time high and continuing to accelerate. What was everyone doing in 2016 at this time when we were getting ready for the prior halving? Which of you were involved in the space? How have things changed?
I was doing the same thing. It was, but in those days, we're talking in 2016, it was around, I think the whole entire network was around 2 exahashes. So it was a different ballpark for sure.
That's amazing. Yeah, for myself, when I initially entered the space, I was more looking at Web3 and Ethereum. So I was actually buying Bitcoin to buy Ethereum. And, you know, I've done a significant pivot after really learning about Bitcoin in 2017 and 2018, where that is reversed significantly. And I'm far more deeply involved in Bitcoin. So to be honest, I was buying Bitcoin off Coinbase and transferring it to Poloniex to acquire Ethereum. And that's what I was doing in 2016.
Yeah, I was not involved with the space, so I'm pumped to go through this for the first time. I was at Intel, you know, trying to figure out if there was some way to make my machines work with other machines, even if they didn't trust them. And now here we are.
How about you, Josh? I know you've been through a halving already.
Yeah, actually, yeah, a couple of them. Well, so 2016, I took a break actually from mining. I was working on an Ethereum R&D project at the time. You know, I started mining in 2013, and you know, had some initial good experiences with hardware manufacturers, and then some bad experiences, and then some very bad experiences with hardware sworn off the space. I'm like, I'm not getting back into that. And 2017, we got a call from, you know, it was a friend of a friend who wanted to deploy 100 megawatts of mining gear, significant. And they asked if I would help them navigate some of the, you know, the hardware vendor issues. And so, well, sure, you know, I'll kind of got back into it then. So yeah, 2016 was a break year.
Very nice. I think we spoke about it. So what's different between then and now? Obviously, it was a break year for you, but how do you see the space evolving? You know, in response. I remember, I mean, I was following Bitcoin, you know, in a similar capacity to Matt, largely using it just to buy Ethereum at the time, not nearly as bullish on Bitcoin yet as I am now. But, you know, I just remember being on the trading desk back at the office, and, you know, it just kind of was like, oh, something happened with Bitcoin miners, not thinking much of it at the time. And now as we've become more immersed in the space, especially since 2017, as we started Blockware Solutions, and you realize what a large, robust ecosystem that, you know, this Bitcoin mining, well, Bitcoin in general, but Bitcoin mining specifically is. It's hard not to kind of imagine, you know, some of the potential impacts.
Well, the scale, yeah, I mean, the scale is obviously, you know, much bigger than, you know, some of the early days, like, you know, 2013, 14. One of the guys we work with, you know, he started 2011, so, you know, so I started buying, you know, used Butterfly Labs gear, like probably, you know, a lot of you guys. And then, you know, KNC, we were buying some gear from KNC at the time, the Jupiters and the Neptunes. And, you know, the scale was definitely under 1 megawatt, you know, so at least for us, it was, you know, probably, you know, tens of kilowatts or hundreds of kilowatts. And, you know, the stuff that we're dealing with now, the architectures that we look at are, you know, 5-6 orders of magnitude, you know, beyond, you know, what we started with. So, The engineering has gotten, I mean, with the increased scale, it's incredible. Just looking at some of these mines, the way that they're architected, the machines, the way that the hardware side has professionalized, and when you buy something these days, like it arrives, for the most part, and then you've got kind of seasoned brokers, kind of in the middle facilitating the transactions too. So, but that wasn't always that wasn't always that way. Like I used to order gear, and it was like, wow, I've got a Butterfly Labs mug that cost me 22 Bitcoin. I sent them 22 Bitcoin to get a 650 gigahash hashing card or whatever, and it was $5,000 at the time. They sent me a mug. They never sent the gear. So there were a lot of stories like that back in the early days, and it's been good because a lot of that stuff is, you don't hear about that stuff nearly as much anymore. Things have just gotten a lot tighter, a lot more professional.
Yeah, totally. Dennis, you've been mining for several years now. How have you seen the space evolve? And, where do you see it heading for miners specifically?
Well, basically, I joined obviously after 16, so I was observing already the results of what was how it's evolved at that time in comparison. And from our sort of point, what we wanted to do, we from the start, the project was structuring. I mean, the whole international team was focusing actually to make it more sort of a bankable, because I think early 17, you had a lot of guys, trying to enter the capital markets, especially in Canada, through reverse takeovers. So obviously, it was a big hype, but I mean, it was mostly focused on, let's say, bringing the retail investors into the space. But from my sort of observation at the time, what I saw clearly, it was already some players emerging. But let's say, comparing to how the industry evolved over the last 3 years, I mean, this is quite a big step, because you clearly have guys who are actually coming now with proper industrial scale operation. There's a more sort of on the technical side. I mean, there's obviously manufacturing and the hardware is a completely different sort of landscape at the moment. Which is in a way, for me, as a sort of my own observation, it looks like we made a step, let's say, from almost like a retail type of mining out of 16 to let's say the industrial scale mining at the halving of 2020. So this is my sort of main sort of snapshot on this.
Alejandro, I'd be interested to see how did I mean, hash rate obviously dropped after the 2016 halving. We're expecting some type of, fairly significant drop, in the 2020 halving. How did that impact your guys' operation in 2016? And, how does it, how are you guys prepared to deal with it, in 2017 or 2020 rather?
Well, in 2016, we had just started, and the operations in the field were more, as Dennis said, more retail oriented. It was mainly there wasn't these massive operations like there are now. We did see a fall, but we prepared accordingly. It was fine for us, but we had just started the pool back in those days. In any case, 2020. Yeah, we assume that most of the small or most of the older miners that don't have enough power to maintain profitability will shut off unless they find a new home across the globe somewhere. So, we've been preparing for this. Luckily, the halving is an event that everyone knows when it's going to come. If it was just all of a sudden, that would be an issue. But everyone knew what day it's coming, which block is coming at least. So we've been preparing accordingly, preparing the finances and whatnot. We see a momentary drop in hash rate occurring, but then I call it the sort of equilibrium where all the new miners will get online, difficulty will rise up again, hash rate will rise up with all these new miners, new mining equipment coming online. And we'll continue to see, I believe, and Poulin believes, that we'll continue to see, the same upward trend in hash rate, bearing a momentary, momentary drop because of the halving. And at the end of the day, this is going to actually, this I think presents an opportunity for new mining, for new entrants to enter the mining space, because they can forecast now for the next 4 years, knowing that there's only going to be 6 0.25 blocks coming in. Bitcoin in each block. There's new equipment. There's new ways of financing. All these guys here in this chat are probably the guys who know most about this in the industry. So it's actually a great opportunity for all the old, inefficient miners to just leave, and new entrants who will come in, and they'll be much more prepared and more professional. And there's a lot of new tools to assist new miners, not like back in the day where, as Josh was saying, everyone has the experience who's been in the industry long enough that you would order some miner and, it was a gamble. Maybe it didn't come, and maybe it would just, the company will bankrupt before you received your miners. That would happen. Nowadays, it's not like that. I mean, okay, there's still some companies out there that do face some manufacturers out there that do have some issues, but mostly you will receive your miners. And and there's ways to finance your new operation. So I think it's a great opportunity. If anyone listening here, any of the attendees are listening here, I think it's, if you've ever considered getting into mining, I think now, after the halving, would be actually pretty good, the best time, I'd say, to get into mining. We're betting on that. So we're not too concerned, to be honest with you. Poulin is not concerned about it.
Got it. Even with it seems, based on reaction to that, liquidity washout, was it about a month and a half ago when Bitcoin collapsed briefly, price collapsed a little bit. We saw a lot of hash rate drop specifically on the more Asian centric pools. We took as an indication that they're running largely old gen hardware, which we got into in depth in our research report. Do you find that to be a concern at all, that there still appears to be a large quantity of miners, specifically in Asia, that are running old gen machines that are going to need to shut off?
Well, I'm not concerned about it. No, I mean, they will have to shut off. And think about it. If you think about it, most of the mining is still taking place in China. So it's only natural that most of these old equipment are in China, because most of the mining takes place in China still. I don't think, like I said, I don't think it's it's going to be a momentary drop in hash rate. I believe that's going to happen. But like I said, new miners are being manufactured right now. They're going to come online sooner than later, and the hash rate will pick up again. Those old mining equipment will probably eventually find a new home somewhere where it's even cheaper to mine than in Asia, than in China, or just end up in the landfill. Who knows? I don't think it's a big concern, to be honest with you.
I just wanted to add on that. I think because everyone was saying, okay, if we would take us back, 2 weeks ago, or at least before this nice increase to price. I mean, everyone's expectation was probably it would be a much sort of sharper fall for some of the miners, but with current price, what we have, above 4K, 8K, we clearly will have some of the guys with the S9s, especially like on a higher tariff zone, still remaining trying to squeeze the margin, until basically they just go completely sort of shut down. But overall, I think the price actually was the main driver now in the last week. And I think it helped a lot, actually, let's say, not to create a lot of a shock wave probably upon the halving, and help also the manufacturers, especially guys who actually planning this whole capital market IPO stuff to boost the profile. And I think clearly it's a positive for overall for the sector, because also on the financing side, because I think especially with new hardware, this is something that will be coming up. But we obviously will see, I guess, the big impact already kicking in Q3 and Q4 when all this new hardware stuff be deployed across the globe.
Ryan, how are investors pricing in the halving over at Multicoin? What are you guys seeing over there?
We've been paying attention to every indicator we could get our hands on for the last 6 months, and long-term holders are holding, right? You can see in the HODL waves, record number of 2 to 3 year old UTXOs that haven't moved, right? Everybody's seems pretty bullish going in. All the leverage in this, like most of the leverage in the system got wiped out on 312. You can look at kind of like total outstanding interest across all the futures exchanges, and it still hasn't even really risen above December 2019 levels. So I'm exceedingly bullish with this recent price run up because it's all been retail driven. This has been Coinbase has had a premium over BitMEX for pretty much like the last month, which means there's a lot more buying going on there than there is on futures exchanges. I think the narrative is really starting to catch on amongst the people who had been kind of Bitcoin curious but hadn't bought in, and then saw this big sharp drop down on 312. All of a sudden, have started buying in. Anecdotally, I know, which is anecdotal, I've had kind of the friends of mine who had always been curious and family members who had always been curious, been like, hey, okay, so now's a good time to buy, right? Like, what's this halving thing? What's happening? I'm exceedingly bullish going into the halving, which, there will be, of course, volatility around the events, but kind of every indicator that we can see seems very strong.
Are you concerned, to your point that, friends, family, more retail driven, inquiries and volume, are you concerned at all, that there isn't enough institutional participation right now, and this is potentially, a retail move that fizzles, and, as traditional markets go, retail gets screwed again? Or just to play devil?
I would generally with Bitcoin, I think it's the institutions that are the hot money and the retail are the strong hands, which is counterintuitive and opposite of most markets. But I mean, a lot of the money that got wiped out on 312, like you can look at the chain, right? These were not people that bought in 2017 or 2018. This was money that bought in December, that all of a sudden sent their funds, screaming over to BitMEX or to, Wobi or something like that, and trying to top up their margin positions, right? It's kind of counterintuitive, but I think that the institutional money has been, over the last couple of years, the hot money trying to run carry trades on futures exchanges and do kind of more exotic things. And the people that just buy and hold have generally outperformed. Now, past results don't determine future returns, right? So like that may not hold true this time, but in a world gone crazy, Bitcoin actually provides a decent amount of stability with blocks coming every 10 minutes and no money printing changing the supply.
Yeah,
I'd be interested to get your take on that, on Ryan's retail versus institutional dynamic.
Yeah, I mean, I think it's extremely positive. You get a new wave of money that comes in between, as we've seen, between 5,500 to basically 8,000. That's a great level, layer of support that's building. So that's exceptional. And I think a lot of funds, I mimic what Ryan says. I think a lot of funds didn't really have a lot of dry powder. So I think, we probably are about to digest here, but I think things still look very good, and we could have another short digestion and another move up. That's what I think the most likely scenario is. And at the end of the day, when you look at, the halving, it creates an event. We've discussed so much about sell pressure, and that's a supply side analysis. Halving, the demand side is just as important, if not more important. So the advance in Bitcoin price is net fiat in or out of the market. And the funds and the retail, they drive the demand side, and the miners are truly driving the sell side. But going into halving, any chance you get where price starts going up, everyone has a bias, a bullish bias. They want to lean bullish. So when you get momentum starting to go in the right direction, miners are going to stop selling coin, and retail and funds are going to start deploying because they have a natural bias to run up into halving. So we've got the momentum going now, and I think it likely continues due to everyone's bias. And the most important piece there was the dual capitulation. March 13th, it was the speculators, the traders. They blew out on the leverage side. That is a beautiful reset to the system. So they blew out. And then on top of that, March 26th, several miners had shut off. We had our second most extreme difficulty adjustment in the existence of Bitcoin. So you had this dual capitulation, and miners are using leverage too. They're collateralizing their Bitcoin to get more either DAI or Bitcoin or cash to pay for their electricity. And so it was a large leverage reset in the whole system. And when you get those type of scenarios, that's how you best position to advance. So yeah, we're very, at the end of the day, I don't like price targets or really trying to predict, but what I do know is a fact is when leverage gets removed from the system, you're very well positioned to advance. So that's really where I'll leave that.
Very agreed.
No, that's a great take. I think to your point, the supply side dynamic that the halvings provided in terms of less fiat out to miners, and then the demand side sentiment should continue. Trevor, I'm interested in learning more about how you guys price, quote unquote, price in the halving when you're offering some of your lend and lease options, in the Bitcoin space. Can you tell us a little bit more about what you look for, the products you offer?
Yeah, for sure. I wouldn't say that we're in the business of making price estimates post halving, but we definitely run through a lot of different scenarios and try to look at what could happen to our loans or leases through those various best case, base case, and worst case scenarios. It partially depends on whether we're looking at an equipment lease, financing the purchase of new mining rigs, or whether we're finding some different structures of Bitcoin-backed loans. In certain cases, we're really not affected by the price action at all. In other cases, we could be. So we want to structure our deals that we're well protected as a lender, no matter what happens to the price and the difficulty adjustment. So we do run through some of that modeling, and that's something that we did with Matt as we worked on that Blockware Mining lease deal that we announced. Just on the last topic too, something else I would add that I think is going to continue to play out and isn't talked about a ton as far as institutional adoption into the space is there's going to be a lot of capital come in from institutions, not through directly holding Bitcoin, but by participating in some of the other products around Bitcoin. So as an example, our business is going to continue raising senior debt capital from banking partners and other senior lenders. There's some other interesting platforms out there in the derivative space. Drawbridge lending would be one that is, bringing in some institutional capital that's investing into yield-generating products built off of Bitcoin. So these could be loans or leases. They could be selling call options. But I think that's a space that is going to continue to attract a lot of institutional capital, along with a lot of the recent pickup in retail action as well.
And just to touch on that and how those things work, when you think about markets, the U.S. equity markets, it leads in innovation, but you look at a chart of U.S. equities over the past 100 years or 30 years, it's basically a 45-degree angle up. We continue to go up. It's a great place to invest. When you look at Europe or Japan, these other countries, their markets have been fairly flat over the past 20 or 30 years. And a significant component to that is debt and access to capital. Access to capital markets. That's what stimulates economies. That's what stimulates business growth, GDP, and it's just a massive, basically buy wall that stimulates an economy, and that's what makes prices move up. So we're just at the front of this, entering into Bitcoin. Bitcoin is so small. The market cap is I don't know, 140 billion. It's a tenth of the market cap of gold. It's half the size of just Facebook's stock, right? So it's so tiny. And now you're going to start to get more professional, institutional participants that are going to lend and bring money into this space. You get these type of effects that could really stimulate the Bitcoin ecosystem, whether it's in investing in Bitcoin or investing in different projects that are going to build on top of Bitcoin or mining. Those are all really, really positive catalysts that are that's stimulus for the Bitcoin ecosystem. And most importantly, the fact that Bitcoin is so small, you get lenders in there, in with just millions or tens of millions, hundreds of millions. It's significant and it's a big deal because presently the market cap is so small.
Definitely. And it's really exciting to see it, especially, that type of debt and financing options come in on the infrastructure level, for Bitcoin, as it is in mining. Trevor, what kind of stuff do you guys look for? You mentioned the Blockware Mining lease deal. I'm sure, and we're already getting hit with questions on that, and what specifically you look for when you're considering providing financing for a mining operation.
Yeah, so when we're looking at these lease type transactions for a Bitcoin mining operation, there's a variety of factors we're going to look at. One is we want to see a team with a solid track record that we think is going to operate a successful business. We are set up to be able to take over miners and resell miners in the case that the deal goes bad, but ultimately we want to be partnering with people that we think are successful. So seeing a good track record of mining profitably is key. We want to understand which machines they're using. We're only going to be providing financing for some of the newest equipment, not on any of the old S9s or anything like that, because they're very quickly depreciating down to zero, and there's very few people that are going to be able to operate those profitably. We also want to understand their price of power, how long they have that contracted for. We want to understand whether they have other significant debt that they've taken on, whether that's through Bitcoin-backed loans or otherwise, so that we understand how levered the business is. So those are some of the factors that we want to look at. And again, just finding partners that we think are set up to generate enough profit to be able to easily pay off the lease, as well as turn a great profit for their own business.
Yeah, that was something that was really exciting. Blockware Mining and Arctos Capital together, we closed out on that deal to get financing. We're very bullish to space, so we were able to lock in financing, collateralize our mining rigs, and we're looking to scale significantly. So and what's also pretty interesting, there's actually a three-way connection here. Josh Metnick of Navier, his team is managing some of our rigs on site, which we're very excited about because they've successfully done it since 2011. One of their team members has been he was a second ASIC with Butterfly Labs and mining since 2011. So our execution is very low, and we're appreciative and glad that we met up to all of Trevor's rigorous standards and kind of got the stamp of approval to lock in that financing. So we're really proud of that, and we're scaling quickly, and we're really excited about that. And that really hits on Alejandro's point. It is a luxury to be deploying today. To have we just put out an analysis, and it shows that if you deploy capital early in a hardware upgrade cycle running into a halving, we ran the analysis when the S9 was released in 2016. That was right before the halving, and you were early in the hardware upgrade cycle. So your machine was more efficient than everyone else's. And of course, everyone else is going to catch up. But mining significantly outperformed just buying Bitcoin and holding from 2016 to present. If you got in the early batch, during the early stage of a hardware upgrade cycle, and you mined, and if you even just selling to cash and you accumulated all that for the life cycle of your machine, you outperformed holding Bitcoin. And if you sold just your operating expense and kind of played with the house money and held the remainder in Bitcoin, you outperformed, I think by, Sam, do you remember the numbers? I think it was by like
5x.
I got
it was 5. I think it's.
How much was it? 5x holding Bitcoin?
I think 4.9. Yeah.
Yeah.
Yeah, 4.9x. You outperformed holding Bitcoin by doing that strategy. So we are presented with an opportunity. There's new mining rigs available, like the S17 Plus, What's Miner, at S19 Pro, and we strongly believe getting into these mining rigs and running them for the next 3 to 4 years is going to be one of the best bets. So we're excited about it. We're providing the services so that miners could access these rigs as well as get acquire cheap hosting rates. We're partnered with a team that's exceptional at managing rigs, like Josh and Navier, and I think there's a lot for everyone on this panel to be excited about. You know, Poolin is gonna capture the opportunity as they provide a leading pool, and as hash goes up, you want to be long Poolin because hash is going to go up. So it's
So yeah, that's why I say we're not very concerned.
yeah, exactly. Hash, that's what's happening. Hash is going to go up. You know, we talk
It
to
will.
Bitmain every day, and there's going to be a point of friction, and that's just how cycles and environments work. But we believe after the halving, there's going to be a friction point where hash falls off, but it's going to get replaced with new mining rigs. And that's exceptional for the price of Bitcoin, because these miners are going to, there's also a check on the network. People aren't going to continue buying mining rigs if the price of Bitcoin doesn't continue going up, because miners really follow margin. If their profit margins are not good and their earnbacks don't pencil out, then they're not going to buy more mining rigs. Like right now, when you look at difficulty projections, Bitcoin's ran up 1,500 points and difficulty is slated to go down 2%. And that's because margins weren't all that great in March, so no miners were really buying. Miners, late February and into March, they weren't buying, and the lead times are typically a month and a half, 2 months. So right now, you don't have these mining rigs that are shipping from China. Typically, there's a 2-month lag, and that's why I say that there's friction post-halving. So if miners would have been buying mining rigs when Bitcoin was at 6,000 or 6,500, their mining rigs would be landing today and difficulty would be going up. But they paused, and difficulty is just net machines plugged in and net machines plugged out, taken offline. So S9s and old generation are still coming off, but you don't have the new hardware coming on, and that's why the price of Bitcoin has soared, yet difficulty is still slated to go down 2%. It's because miners were late to deploy, and there's a lag time to get them from China. But now, a lot of these S17 Pros, now miners are coming back into the system and buying mining rigs right now, and they're not going to get they won't land and get plugged in probably till late May or into June. And that's what's going to support Alejandro's thesis of hash rate is going to go back up, because those next gens will get plugged in. I mean, they're paid for. A lot are sold out, and they will get plugged in, but there's a lag. So that's why we discuss this friction. Yes, price has gone up, but there's no mining rigs to plug in because they're still in China. They're still getting manufactured. And old generation is coming offline. So you see Bitcoin go up 1,500 points and difficulty going down. That's the opportunity. And that's what we discuss with miners and why they need to be positioned before the opportunity is there. Because the guys like us, Dennis, others that are mining, we have our mining rigs on site. You can't play this game of chasing. It's the beauty of mining. You're essentially dollar cost averaging. And if you stick to a deployment cycle, you get to capture these opportunities where Bitcoin has ran up, difficulty is going down, and profit margins are exceptional. And that's what we're going to be able to participate in over the next, until the next difficulty epoch. All the other miners, they have to wait for their mining rigs to get plugged in. And chances are when that comes in a month or two, margins are probably going to be lower. So that's why you have to be very consistent, and you don't want to get caught where Bitcoin runs up and then you start chasing rigs and you're waiting 2 months for your mining rigs to come.
That's a perfect time to sell your miners when that happens.
Exactly. So, you know, really having strategies, really having plans, having access to rigs immediately, and almost dollar cost averaging. I think that's the best way to approach Bitcoin. It's a technology in its infancy. I think you want to have a long-term view, and you want to be participating in opportunities like this. You know, mining rigs were at lower prices the past 2 months, and you got to participate in when there's pullbacks as well. So,
totally agree. Ryan, I'm interested. What kind of interest are you seeing on the venture capital side in the mining space?
Yeah, so this is really interesting, right? Because there is, and I think Blockware's, y'all, and Matt's work is really well timed, because there is still the meme that, you know, why would I take the risk of investing in a mining farm when I could just buy Bitcoin and hold it, right? So that is tough to get through. But the way I think about it, there's kind of like 3 tiers of miners, and I'm really curious for feedback on this. First is like the kind of like small scale energy scavengers is what I call them. So like the folks looking to take flared natural gas from the wellhead, right? Where like the maximum energy per site is, you know, a couple megawatts. You can't really do really large scale. There's a lot of operating overhead. You're at the mercy of kind of the power producer or the oil industry, you know, to where that energy is even available. But there's a lot of them, right? There's a lot of places where that can be. And I think included in that are the people that are flying their ASICs to Sichuan for the rainy season, right? Where they just go and take the free energy when it's available and then they leave, right? That is not really a very good venture investment. That's not very scalable. Then there's kind of like the behind the meter folks, like the Green Ridge generation that just did the hash swap with Biduda that got a bunch of news, right? So that's behind the meter because that's a power producer, you know, traditional PE shop that owns a natural gas plant, who has some excess energy that they want to turn into Bitcoin, right? So that's a little bit more interesting because then you can get, you know, 10 to 30 megs or something like that on a single site. It's a little bit more scalable. The PE shop probably has access to debt capital, so a little bit better capital stack, a little bit more, you know, potential profit there. But you know, you still have to have access to that energy. That's really the key. So investing in that is hard. Then you got the kind of like mega facilities, right? Like the ones that are right up the road from me in Rockdale, either the Northern and the Windstone guys, the 100 meg plus, buying wholesale power from the grid. You know, kind of got to have political connections to make sure that you get long-term access to that type of power. But man, if you can get it and you can do, you know, if you're down here in Texas, you kind of need to do immersion cooling. If you're up somewhere else, you know, maybe Dennis's, you know, locations in Kazakhstan, maybe you don't need that quite as much. But those kind of bigger facilities, you know, you can talk about cost per Bitcoin in like the thousands of dollars or something like that, right? 1,000 or below. That is, you know, a real scalable kind of long-term venture style investment that I think is interesting. And I think that there will be, you know, traditionally the real venture scale investments in mining have been ASIC manufacturers, right? That's been so far like what I would consider like a big exit would be getting in the seed stage of, you know, Bitmain or one of the others, Canaan or eBang. I think there will be more opportunities as the ecosystem continues to grow, but kind of in those 3 tiers, serving those bottom 2 tiers, I think is a really interesting opportunity. But just in mining specifically, it's that highest tier of the kind of politically connected, grid powered, large scale facility.
Totally. And that kind of segues perfectly into Josh. That's a little bit of your wheelhouse. Josh and Navier Inc. have had experience building out a variety of different style and location mining facilities, whether it's an old industrial plant with excess power available, or a large generation site like you mentioned, like Greenridge. Josh, I'm interested to get your thoughts on some of the factors you look at to determine the viability of a mining location.
Sure. Yeah, it's a great question. And Ryan, I agreed with your categorization there. I thought that was really well said.
Great.
I think there's an intangible kind of subjective, get to know the local operator, kind of phase where, the numbers themselves, sure, you need cheap power, and it's good to have it in a location that not only has, cheap power, but cost of labor and materials, and just kind of staffing and running the mine in a given region is inexpensive as well. But when we construct one of these facilities, or we get involved in a new facility, we want these facilities to last for 5-10 years, ideally. So just understanding kind of what the local environment is like, what the regulations are like. Are they going to be okay with this? Do they know what they're getting into? And are we partnering with good people that can operate this thing? Like that's very important. Getting low cost of power, getting low cost of materials. Those are boxes that have to be checked. But they're a bit more they're a bit more clinical. I think building to that 5-10 year type vision. Building in a location where you can scale is important too, right? Because you might start at 15 megawatts, say, but you want to know that there's a clear upgrade path to 200, 300, 400 megawatts, which might sound it might not sound insane, to this group, but when you're thinking long term and you think the power density continues to increase significantly, every 2 to 3 years, you've got to be building a location that can actually service that amount of high voltage. And then I think the last thing, which is kind of related maybe to the types of people that you get involved on the construction and the engineering side, you got to be able to build it quickly. It's a race against difficulty. So if we're looking at building a 50 megawatt facility that can be done in 18 months, at a cost of X, but there's another location we can get it done in 6 months and it's a cost of Y. The time to build, time to live becomes important too. So there's a number of things that we take into consideration. Sometimes incentives have played a big role, like electrification incentives, local power utilities. Sometimes Bitcoin mining equipment will actually qualify for I guess we're more historically more traditional kind of industrial incentives. So we incorporate those, and of course there's the modeling itself and that, but from a site location perspective, that's what we look for.
I wanted to add basically on Orion sort of classification. I think it's a nice sort of angle to that. I think it's clearly what we see, and we're probably going to see it's sort of a certain niche market for this opportunity-based mining. So where we define there's a lockup of electricity in some areas, either in a gas flaring, on a renewable side, where is a difficulty with access to the grid. And this is the one side. I think the other sort of the niche market that will remain is obviously, let's say, they call it more sanctioned locations, which will absorb a lot of second-hand hardware, which basically are trying to deploy it for their own sort of needs because they need to facilitate some international trades or whatever. But the main sort of the market is evolving already, and we see basically the miners basically is starting sort of to classify inside the mining basically space. You already see the guys who are actually more focusing on the hosting side. So in a way where we see it's a clear alignment with traditional industry, like you have a data center segment where the guys are providing the hosting locations, and the other guys who basically the miners who actually control the hardware. This is something that will be interesting because we see more and more institutional guys coming, and this is what Miles said is actually the actual importance of getting access to financing. And with the new hardware coming in, I think it's actually completely can reshape the whole sort of landscape and the footprint of the hash rate. Because I mean, at the end of the day, I mean, the equipment getting more powerful. So basically, in terms of a hash rate generation, So within an existing sort of a 50 megawatt facility, you can put hardware. If you can actually now fund yourself and upgrade with a new generation of the hardware, it's completely different mining farm you have comparing to your competitors. And this is again what I said in terms of competitive advantage. And the most thing what I saw basically, because we run a lot of process with the big four over the last sort of originally like 17, 18 to see how the market is developing. But to my surprise was how fast basically the US market was developing the whole ecosystem last year, let's say from end of Q1, in terms of, let's say, the trading venues, how basically the market cleaned up and you see the big development there. And plus all these structured products, because clearly the financing options is a key for, I think for any miners, obviously, the price we're monitoring on a daily basis, but the more sort of tough part for that is actually getting the funding. And I think at the moment, what I see basically is three groups of, let's say, they're trying to enter the financing. What basically Matt did with Trevor is I think it's a good classic thing, but you need an exact expertise because it's almost like a project finance. You come in, you need to assess the site, you need to assess the team, basically, and basically you understand your risk management, you need to price it and say, okay, guys, we're moving in. And this is a great thing and much more comfortable, let's say, for miners, because at the end of the day, you understand they're trying to sort of align themselves with a risk profile. So they're on the hardware side, on everything development. The second group is clearly the guys who mostly focusing on more liquid collateral, more from a trading angle. This is where we're trying to take a BTC as a collateral. For me personally, because I remember from a traditional mining space, I mean, this is something where if you take a hedge and basically there's a margin call, I mean, you're shooting yourself twice, basically. I mean, because, and I think this is one of the things for the mining community. I think this is new products who should be coming in. And the other thing is basically interesting thing, which I saw recently re-emerging over the last sort of 2 weeks, is a more request from a trading sort of venues who see interest from institutional guys saying, can we actually participate in this proxy on access to the hash rate instead of buying the BTC directly? So, and this is in a way that might create a good sort of ecosystem for this sort of offtake sort of for the miners basically on the hash rate. And I think this is something which clearly would be very comfortable, especially like on the working capital management side. You know, if you actually can go and try and sort of to pre-sell all your hash rate, let's say for 30 days, roll over sort of and fund your needs as they emerge. So yeah, it's clearly a sort of fascinating time now.
All great points. You know, what I really enjoy thinking about is how do you price these different products, because they're de-risking, and what's the value of that de-risk, right? So to get a contract where you're guaranteed hash rate, what that is doing is it's saying you're going to get X amount of hash over X duration, so over 1 year. So the value of that, the premium paid for that, is the execution risk of mining, really, right? So if mines typically have 92% uptimes or 88% uptimes, and you're getting a contract that's achieving 100% uptime, right? Because you're getting guaranteed hash. Those are going to be elements that are components that are involved with pricing the premium on these hash contracts, because the hash contracts eliminate the risk of you having an electricity rate hike, or your mining farm going down for 2 months out of the year, or your inability, you know, your X amount of machines go down and become, you know, break or whatever. So I think those are really fascinating things, and you know, there is going to be an appetite for yield. And if we can create these products so that they're very institutionalized and provide an 8, 12% higher interest rate, and you can hedge off to really secure your principal, you know, you need good counterparties. But if you could get these type of products, you're essentially creating a bond. You know, you're creating a bond where your principal is secured or more secure, and you have your interest rates. And that's what's very interesting to me, because I think that's what could put more institutional money into the system. You know, right now there's DeFi and they have a higher interest rate, but I think it's not stress tested, and I would just never, I wouldn't get involved in lending my crypto to a system that isn't stress tested with, you know, with DeFi yet, for a 6 or 7% interest rate. That doesn't make sense to me. It's just not there yet. But I think with hash contracts and getting and difficulty contracts, hedging off difficulty, I think you're eventually going to be able to create the equivalent risk of a bond with better cash flow being higher interest rates. And now you can compare some type of asset that is lower, that is of equivalent risk, yet higher yield. And I think that's where you start to get traditional money managers looking at this. And once they it'll be an education process, but looking at this and wanting to get involved.
I think, Matt, I just wanted to add on this, because it's clearly where the market is going, but you will agree that because you clearly in the market and travelers, you know, and you have an external knowledge, very deep knowledge of the market. So your expertise, this is how you build basically an assessment of a specific site or a specific counterparty. And I think this is what is actually at the moment still missing in the market, because clearly there is a market, so money managers, they want to come into someone, but they want to come into someone, but underwriter in a way, who actually has a genuine expertise in the market and says, guys, you know, this is actually, we're going after these sites, you know, this miners and this team, because we understand, and this is a hardware. And I think this is what still, let's say, only start to emerge. And I think this is, we have, let's say, the interest coming through, but it doesn't know there's a bottleneck where to go, basically, and push this funding, because, and I think this is something that I probably, I would like to see that it's emerging now, you know, on the next sort of few quarters, we have more players in the market who are actually trying to sort of facilitate it and bring this to become a bridge in a way. Because I think it's a great thing, because we see more and more guys actually entering the field from a different angles, you know, some comes from industry, some banking, commodity trading. And I think this is a good mix where we actually start seeing the real sort of platforms that can accommodate this bridge function now.
Totally. I totally agree with you. It's going to take time. It's absolutely going to take time, but what's important is we're moving in the right direction. And we have the products starting to get built out. And you know, what you said, I think a lot of people may have missed it. Dennis is using the big four for audit, right? Like when you start to get, or I don't know if it was audit, but for services, when you start to get a lot of comfortability and you get these market participants like Dennis's farm that are really, it's about being investment grade, right? It's about being investment grade, leveraging, doing things the proper way, setting up entities the proper way, being in countries where money is willing to invest in, right? There's a premium. I think there's a premium and a lot of value for mining in the US, because I think lenders and investors feel more, they absolutely feel more comfortable with deploying their capital to the US. I'm sure, Dennis, you know, there's a lot of economics that are achieved by mining in Kazakhstan, but you also have these operations in Canada and the US, and you probably get different pushback from your investors, whether they want to deploy to Kazakhstan or in the US or Canada, because of stability and regulation and whatnot, right? So I think being investment grade and having the development of products that are investment grade is gonna really improve the system, as well as just the market participants that are involved.
I can actually add you on this, because I traditionally came from banking. It's EBRD, which is similar to IFC. So basically, this is actually the mandate of a bank was you come to a business who is basically trying to merge, to evolve, let's say, from a family-run enterprise into a corporate structure, and do with always upgrade to it, you know, in terms of processes, you know, like audits. And this is obviously creates a premium. And I think this is what's actually already start happening with some players in the mining space who understand, in order to tap into the capital markets and to be able to accept it, you know, you have to actually make an extra steps forward. And this is what we've been doing. I think in Kazakhstan, actually, it was very sort of, well, I mean, it was interesting development, because when I originally came there, it's September 17, we set up an association, which in a way became a a platform for policy dialogue with the government, because we said, okay, guys, you have a lockup in electricity, you're actually selling for cheap. We took a team of people to show how it's done in Sweden, like how it's all basically development was taking place. And I think, obviously, you're absolutely right. In terms of, let's say, economic-wise, if we look at the tariff, we obviously have an additional, let's say, a margin there that obviously could be achieved. But at the same time, if you can, there is obviously a country risk. We all know that. If you look at the different sort of profile with clearly the US is clearly one of the sort of safest location for investors to go in. There's obviously a premium. So then this is a slight offset. Strategically, we see, okay, we have a full sort of a capacity which we can expand, let's say, within existing facilities. So i.e., it is no project implementation risk at all, to scale up. But at the same time, we understand basically if company wants to be sort of more capitalized and grow sort of as an international player, it needs to create the footprint. And this is what we've been looking at in our location. And I think we're quite happy to see that the North American market is actually offers a unique opportunity, because you have a multiple supply of energy resources, you have a multiple sites, and this is what's important. I think Trevor or George said that it's actually that you have a cluster where you can scale up. And I think for the mining, it's very important. You don't come in and saying, okay, I'm going to do a 5-10 megawatt. You need to understand there is a roadmap. You actually can do 50, 100, 200, and it has to be done in one cluster where you can do economies of scale. And I think this is also that you have in North America as well. And clearly, I think that it will change, like the overall footprint for the hash rate globally. But yeah, it will be interesting sort of changes. Yeah.
Totally.
Yeah, I mean, it's really going to be interesting to see how the space evolves as we continue to get, more and more institutionalized, the mining specifically. Obviously, we saw Canon IPO. eBang just announced that they're looking for 100 million. So, I mean, hard to say. Alejandro, how do you think the increased institutionalization is going to affect the larger pool community? Like I know there was some bad press, well, some false press about the Bitcoin mining network being controlled by 3 miners when they're referring to you and the other larger pools. I'm just interested to get your thoughts on where you think the space is heading and how that's going to impact pool participation.
Well, it's a good question. It's going to be if more of more mining farms are getting financed through whatever instruments there will be in the future, they're going to have to join a pool. So that's always good for us. I do think the mining pool industry is also becoming much more professional. Back in the day, it was just a couple guys, throwing things together, small team. But now it's really becoming something we have no other choice but to also professionalize as well, because if there's these new infrastructure plays and new financing options come into the market, we have to be there to provide the correct platform for these things in a sense. So I think at the end of the day, it's also good. This might, competition is always good. This might allow new players to come into the mining pool business, which is fine, right? I mean, it's good. It's an evolving industry. So there's still enough space for new entrants to come in. No problem. That's only going to create more value for everyone. But yeah, basically, I think pools will have to evolve with the market. Otherwise, we won't be able to, to take advantage of this new world, so to speak, coming in.
Totally. And I mean, are any of you guys worried about a, concern that with the growing demand institutionalization, there's going to be a flood of, new ASICs or new manufacturers that, that hit the market and end up shooting up difficulty?
Well, I mean, if if new financing comes into the industry, then there's more value. So there will be new entrants coming into the manufacturing play. I think ultimately, getting manufacturing out of just one region, that right now it's just China, having other sections of the globe creating mining equipment is always a good thing. I think it's necessary. There's a bottleneck right now. For example, Corona, made shipping very expensive. So a lot of these mining equipment, like the traditional cost of bringing the equipment to the United States, let's say from China, was this amount. Now it's skyrocketed because of this virus. So like these type of things would not be an issue if there was a manufacturer in Europe, or less of an issue if there was in the United States. So I think we do need more manufacturers in this space. One of the bottlenecks that I do still see not being talked about, not even being looked upon, is the chip foundries themselves. You can have all the manufacturers across all the damn globe, doesn't matter. But if the chip foundry is just TSMC and Samsung and X, right, whoever it is, three major, then it doesn't really matter, right? If they're backlogged because of the new iPhone or the new PlayStation, then they're backlogged because there's only 3 of them. So that affects the whole entire market in manufacturing terms, which in effect creates an issue with difficulty instruments because they control the manufacturing process in essence. So difficulty, any type of financial difficulty instrument, it's going to be difficult to do because they're the ones in charge, right? They're the ones who know when the new miners will come out. So there's a player that has a very strong hand there. So I see that as something that everyone should look into.
That's a really good point.
I'd love to get your opinion, having so much exposure to the mining space via Blockware Mining Fund and obviously Blockware Solutions. Are you concerned at all about, new manufacturers or even existing ones, flooding the market with too much hash rate and making it uncompetitive?
Yeah, I get that question a lot. Different miners who ask me what happens if Bitmain or MicroBT or Canaan just flood the market with mining rigs, just sell a bunch. And I'm not as concerned about it. And I think there's really a check on the system. It's really a game theory analysis. And I think there's a check on the ecosystem, because when you think about a mining rig, all it really is, it's a server that collects future cash flows of mining, right? It's future cash flows of Bitcoin. It's your mining rewards. So if that rig is going to run for 3 years, you sum up what you believe the future cash flows over the next 3 years that you're going to receive, and that's the value of the rig. And that value is what a manufacturer could sell the rig for. So if they make, and the margins, the rewards are determined by the price of Bitcoin as well as difficulty. So if a manufacturer makes difficulty go up significantly by flooding the market with mining rigs, then they've destroyed the margin in the mining rig, and therefore the mining rig doesn't make a lot of money, and therefore the mining rig is useless. And the manufacturers just got all of this inventory of mining rigs, and they need to be able to sell them at a specific cost above their production costs. So that's really the check. Manufacturers kind of have to control the supply and not release too many and cause difficulty to go up, because that'll implode the margins on the rigs, and then the rigs are worth less, right? So people are just not going to buy them. So I'm not overly concerned. And then what Alejandro went into, you need to, people also bring up layer one, and is layer one going to start making their own ASICs and completely implode difficulty? Well, I think in order to really get involved in manufacturing ASICs, you need to capture economies of scale and really do it at scale for it to be feasible, for you to do it yourself or sell them. And I don't think Layer 1 is getting in the business of selling rigs. I think they want to manufacture their own rigs. And without the expertise and the experience, they're probably not going to capture and create mining rigs that are super efficient. And on top of that, they're not going to achieve, I don't believe they're going to achieve economies of scale because they're just going to be doing it for themselves. So their mining rigs are going to be outpriced and it won't make sense. That's kind of just an opinion, very high level. And that's a result of what Alejandro brought up, that ASICs are a little pebble to Taiwan Semiconductor and Samsung. It's immaterial. The revenue generated.
Irrelevant.
Irrelevant, absolutely. Yeah, you're competing with Apple and much bigger.
Sony.
Yeah.
You're literally a rounding error. You're a rounding error on their balance sheets. So you know, you're not going to have any bargaining power with the component makers. And if you're not doing it at massive scale, you're not achieving the low costs. So I think it's not something that I lose sleep over.
This is what Ryan said about the venture entering this, because I mean, it's a typical story of Raspberry Pi for you here. You know, it's basically where you go and you can acquire that, and obviously, if you have enough funding, basically you can create a product and push it to the market if you have a scale, basically. And yeah, and at the moment, I think this is clearly the market, and I think the investors would be willing to finance it because they understand this bottleneck, and actually the coronavirus, as Alejandro said, is actually clear indication that everyone now is affected because the lead time for even newer the hardware, I mean, it is being impacted. Obviously, you have the flights, we have less flights, clearly is less cargo. So, I mean, we have a continuous things, and that's why I think it's a good opportunity also for manufacturers, especially setting up a location like US, Europe. Clearly, it's a good opportunity.
You know, Bitmain, them just having that Malaysia plant, when the Shenzhen facilities were down, they were still shipping from Malaysia. We had several orders that did not get delayed because they had it. They had the Malaysia plant. So whatever that is, assembly or whatever is going on out there.
Assembly.
Yeah, but taking that to the next step and having something in either North America or Europe would really diversify the supply chains. And coronavirus has really stress tested the global economy and showed why it needs to happen.
Yeah, I think the only way you get another foundry is if Apple really does get rid of Intel chips in their laptops, and then somebody starts eating away at Intel's market share and servers. You could see Intel try and spin off some of their assets, which, like, the facilities I worked at in Phoenix are enormous and have massive capacity, right? If you could sell off some of those, and they're vertically integrated, they do the whole, you know, all the steps all the way through. You could spin off some of those, get them bought by somebody interested in doing foundry in the US. That's about the only way I think you could do it. I mean, that's just such a capitally intensive business with such entrenched incumbents. I don't know if you could start from scratch and build a new one. I think you have to buy existing facilities, and that's the only way.
You would also need some sort of government help there too. I mean, it can't be
definitely.
done.
Yeah, we need some nationalism.
It has to be done with the help of the government.
Absolutely.
Guys, let's address some of these questions. So Leonard, he asked, what are your predictions before and after halving? Who wants to take that on?
I'll take that. Bitcoin is going to be running just like it should. It's going to be secure, financial freedom for everyone. It's going to be fine.
Perfect.
Flux every 10 minutes, baby.
Every 10 minutes.
Give or take.
Yeah. I'll just keep it high level. I think it becomes looking long term, fairly irrelevant. I think overall it's excellent for the ecosystem that we have a technology where the monetary policy is dictated by code, especially in a present environment where central bankers and the Fed is just printing subjectively. So I think that really resonates with market participants. I think we are going to, if Bitcoin stays at present levels, I think we are going to experience that minor capitulation. I think it'll be super healthy for the ecosystem, but overall, we continue a trend higher in hash. That's why I say long pool in if you can, get exposure to them. And I think after it all shakes out, you know, there is going to be less sell pressure, you know, less coins available to sell. I think that's very bullish for Bitcoin. And I think the fundamentals of Bitcoin are better than ever. I think what's going on with coronavirus and the U.S. economy, it's really put a spotlight into systems that are too centralized, or you have a few people kind of dictating and doing whatever they would like, and that's going to make some people start to look at Bitcoin and want to take allocations to Bitcoin, and that's really how we achieve this digital gold narrative. So I think it's having coupled with the global economy, I think it's very, very positive for Bitcoin.
Yep, agreed. Couldn't have said it better.
All right. If anyone else have anything they want to say there, or we can move on to the next question. Trevor?
No, let's move on.
Okay. So Tom McCarthy, hi everyone, thanks for organizing. Thoughts on massive dollar shortages and rush into Bitcoin in emerging markets like Lebanon. Will this be another Cyprus moment for Bitcoin?
Certainly could be. The first Cyprus moment wasn't like a really, like, it seemed like a big deal to the niche community, but it wasn't a really big deal outside of it. I mean, I think you'll just see more and more emerging markets collapse before Bitcoin. Unfortunately, though, what we're really seeing is massive growth in stable coins or crypto dollars, right? That's kind of a preferred solution right now, just given volatility. I think what'll be really, really interesting is that growth, people kind of spilling over from there into Bitcoin. And then if we can get really massive growth in side chains or Lightning Network stability and get Tether or crypto dollars running on top of those payment rails, I think you'll start seeing a lot faster spillover into Bitcoin from there.
I'll throw out there, I think Ryan is probably one of the lead analysts in the world with what's going on with how Bitcoin could capture the opportunity in you know, with what's going on with Bitcoin essentially eating up some market share of Web 3.0. So reach out to him on Twitter or email, you know, Twitter, he gave me an education on it and it was exceptional. But I completely agree with him. What people in these, in the present environment, people are looking for stability. And Bitcoin is a technology in its infancy. It's very volatile. Mm-hmm. So I think people are moving towards stable coins. And we know that because the market cap of coins keep going up. But this kind of ties into what we discussed earlier with financing and capital raising. You know, when we raise capital, you almost want to go to people that own Bitcoin, you know, large Bitcoin whales, because they understand it. You're not getting over this huge education hurdle. Number one, I have to educate them on what Bitcoin is, and then I have to educate them on what my Bitcoin mining fund is, right? Two areas of there's two hurdles there, right? So that's why it was such a great experience working with Trevor, because they deeply understood mining and Bitcoin. So I didn't have that barrier. And then I actually ended up sending him the research report, and I was able to say, this is what's probably going to happen with difficulty. And I think that kind of helped them with their models a little bit. So same type of thing, which I think emerging markets, these other countries that need stability, I think they initially flow into stable coins. And we're seeing that with Tether and other stable coins, market caps go up, but it's significantly bullish for Bitcoin, because now you have people in the ecosystem. You have people in the ecosystem who have who are using the blockchain, and that's really step one. Get them into the ecosystem, and now you have. I'll tell you, 6 billion of Tether. You're probably going to get more of that money injected into Bitcoin than 60 billion sitting in a couple Morgan Stanley, Chase bank accounts and Goldman Sachs or wherever, Bank of America, Chase, yep. Wells Fargo. That is money that is in the ecosystem is far more likely to eventually move over to Bitcoin. So, I agree with Ryan. I think a lot of these emerging markets and these other countries that want dollars but can't access it, they're probably better off going into stable coins because they're looking for stability. They're not looking for digital gold that is presently volatile and still has to do more adoption and achieve more to truly become digital gold. But what's really important is that is a significant probability of eventually flowing to Bitcoin, in my opinion. So you got to look at it through the long term. So I think it's very good for Bitcoin.
I want one really quick shout out. If you're interested in this topic, Matt Alborg at usefultulips.com does some fascinating research into emerging markets and their usage of Bitcoin and stable coins. He just put one out recently. He's done one on Venezuela. He just put one out recently on another South American country. I can't remember, but it's really fascinating stuff. The user behaviors are really interesting.
Thanks.
Yeah. No, it's
the questions we have.
I'd like to understand your views on the role of immersion cooling technology on Bitcoin mining in the future in terms of enhanced hash rate, increased energy efficiency, reduced capex and power density. From Sayan. Yeah, I mean, it's definitely a trend we're starting to see, become more and more popular, for miners. I believe, as Ryan mentioned earlier, especially in Texas, with heat being what it is. Josh, do you have any thoughts, any opinion? I know you guys don't do immersion specifically, but what are your thoughts on it? Might be frozen.
Yeah, I mean, there's some really cool tech out there. Like I visited the GRC instance in Lightspeed hosting. I went out there to see that, and I think there are some increased operational costs, for sure, when you're doing immersion. Like some of the machines, in order to even like repair them, they had to be taken out with a winch, the power winch to lift it out. And there's a lot of operational considerations that I think add, just add some friction and some costs in maintaining it. But yeah, I think there's a lot of opportunity there, for the right locations. Like I was in Bahrain about a year ago, actually, and we were thinking of partnering with a company that was in Kuwait, and I think the energy rate in Kuwait is like, it's really cheap. It's like 1.2 cents or something. But there's a lot of other other costs in it. But running an example of a location where that where immersion might work well would be in 130 degree heat, right, in Kuwait, or 140 degree heat. Like immersion might work very well there. We've never had an issue with air cooling in the United States, and we're running in some pretty in locations that actually get pretty hot. So I think that the counterpoint to this is that the engineering on the air cooled stuff, just every year it gets better and better, more impressive, from the machines themselves to the engineering in the mines. And so I think immersion holds a lot of promise under the right kind of set of circumstances. The air cooled stuff is still super cheap to build out, and it gets better and better every year. So
yep.
Yeah, I think it's one of the most interesting technologies out there. I think the leaders right now are probably immersion systems. If you guys have the opportunity to reach out to the Blackmans and Nathan Nichols, those guys really understand this stuff. I don't know what information is confidential or not, but Immersion Systems, Imperium Fund, I think those are groups that you want to look into that have figured this out and are creating significant cost reductions as well as higher revenue generation. So yeah, I think immersion is something that is continuing to improve and I think it's still at the forefront. And mining it's all waves, right? Right now we're in a hardware upgrade cycle. So those that are upgrading their hardware are going to have significant advantages over those that have not done that yet. And that's on the mining rig side. Now I think we'll probably have a future wave. There'll probably be two other waves, right? It's where could you cut costs? Where could you increase revenue? Mining operations, they're truly large, comprehensive cost accounting problems. That's what they are. So, you could have the best technology in mining rigs. You could operate super lean, and I think that's what immersion cooling is going to achieve. I think miners are going to be able to hash at very high rates and keep their watt consumption low. And on top of that, it's not going to deteriorate their machines because the machines will be in the liquid cooling, so they're going to last for a long time. And then on top of that, the other piece is how do you get very low electricity? So these are all things that are going to evolve over the next 2 to 8 years, and people are going to capture these competitive advantages. And I think right now the competitive advantage to capture is being in the very newest and most efficient mining hardware. But over the next probably 6 to 18 months, it's going to be how do you really operate efficiently with your site designs and your site build outs. And I think immersion cooling is going to be that competitive advantage. And I think it's going to take time, and there's a lot of learning and more innovation. But I think that'll be the wave that occurs a year from now for the next 4 years. And then in the future, who's going to be able to get this dirt cheap electricity? So those are different waves that are going to be, I think mining is going to have cycles of upgrading and operating competitively. And I think those are potentially the waves that are going to occur.
Yep. I would absolutely defer to Josh's expertise on where immersion cooling versus air cooling is appropriate. The things where I mean, if you have, it definitely requires a lot more CapEx upfront. So I think for the big sites that have access to cheap debt, that's probably a better place for it. If you have access to a big site, access to cheap debt, and you're in a really hot and dry environment, maybe it makes sense. But yeah, I mean, mining it's absolutely it's a brutally capitalistic game, and this definitely brings in a lot more overhead. So it's not right for every place.
Totally, great point.
Trevor, have you explored any financing options with anyone in the immersion type mining game? And
we've definitely spoken with groups that are using immersion cooling. We have not looked at financing the build out of any of those immersion systems. So we'll take, if there's a mining company that is using that technology, we'll take that into account to see what hash rate they're able to run their machines at and plug that into our calculations. But we're not going to look at financing the build out itself right now.
I saw a prototype of a oh, can you guys hear me? I saw a prototype. So it was in a power. It was in a power electronics lab. It wasn't a Bitcoin mining machine, but it was a PCB board, and it was a 3.5 kilowatts of processing power, the size of a credit card. It was about the size of a credit card. So that's the processing power of an S17, right? In one credit card. As we move into extreme, form factors like that, I mean, there might be a way to air cool that one. So I'm kind of taking the opposite side of what I was saying before. But, I think there may be a point where 5 years from now or something like that, if the power density keeps going up and up and up, where, some type of immersion cooling might just be table stakes. Like, you need that. Yeah, right now there's a lot of really good air cooled options that are way less expensive and less complicated.
Thanks. Does anyone else have any other comments on immersion, or should we hop on to the next question?
Let's keep moving through questions.
All right. Hey guys, can Bitcoin be a driver for digitalization of nuclear power? They've been 3 phases behind the curve and operate very ineffectively.
I'm going to answer a slightly different question. One of the things that I think is most exciting, actually, so I have a buddy of mine who raises capital and builds renewable energy generation in underdeveloped areas, so like Rwanda, East Africa specifically, right? He has this problem right now where they build 30 megs of hydropower for this location, and there isn't enough demand from the local populace to buy up all their power, right? People don't have washing machines or air conditioners or anything like that, right? So they're lacking this demand. He actually is not a Bitcoiner. He came to me specifically and said, hey, is this a problem that Bitcoin mining could solve? Like, could I install mines on my site and monetize this excess electricity that I have, right? I was like, oh my God, that is exactly what it's for, right? Like we could plunk down some shipping containers, monetize your electricity right off the bat, kill 2 birds with 1 stone, and then once the local populace can buy the electricity, send the miners elsewhere, right? So I'm really excited about that. And if any of you guys know any mining experts in East Africa, please let me know. But there's all this opportunity for, monetizing new generation capacity in parts of the world that don't have generation yet, that I think is a perfect fit for Bitcoin. And, maybe that stretches all the way to new nuclear generation. I don't know, that I'm not an expert in nuclear energy. I'd imagine that there's a lot of red tape around that.
Our facility actually, and Josh, you could probably speak to this best, right? Like our facility is hydro and nuclear, right?
I think there may be. I think it's primarily hydro. So there's a dam that's about a mile away, that provides most of the power there. Because all these grids are so interconnected. I imagine if they had problems with the dam, there were peak loads, so they're probably running it, from wherever they need to, including coal, nat gas. I think there might be a little bit of solar on that grid. So it's hard to find, what Ryan was talking about, like a, kind of a, I don't want to call it quite a stranded asset. I think maybe that's the correct term or not, but certainly, an underutilized, asset that's not connected to the grid or only partially connected to the grid. I agree. I think there's tremendous opportunity in those situations to mine, while you can. Nuclear, I mean, from what I understand and the analysis that we've done, like nuclear is actually an extremely expensive source of energy. So there might be a plant where it makes sense, or they've got some different, some cost advantages or whatnot. I think in Belarus they're mining with nuclear power, from what I understand, and it might be other issues mining out there. But and I think the head of like Lukashenko or whatever, I think he announced like a tax moratorium or something like that. Sounds kind of risky, to me, but I think there are people using nuclear, and I'm just not. It's pretty expensive from what we understand.
Got it. So we've got someone asking about what is an acceptable mining rig failure rate range. Several of the S17s and T17s have a 20 to 30% failure rate. Normally 5%. Heat sinks are falling off. Jihan is begging customers to give the S19 a chance and blames everything on McCree. So what do you guys think? What's an acceptable mining rig failure rate range.
I think, Alejandro, you want to comment? You're just like, having a laugh.
Got something.
Except
That's a really, really funny comment. That was a really funny comment.
My opinion, acceptable is 0. There should be, right, that's on us as customers. The fact that we accept it is and that's what competition does. So microBT is relevant competition. So the manufacturers have to take their customers more seriously. They have to develop a better product. So I think it's a very good thing to have competition, because before you could just have this defection rate and customers don't have any other option, and you have no bargaining power. So I don't know if the average defection rate was 20 to 30%. But I know when we procured some S17 pluses in December, our defection rate was pretty high. We don't know. Then again, we deployed with another facility, and the defection rate was about 1%. So we don't know if it's the machines or the operators or what's really how to differentiate that. But yeah, we're glad we're working with Navier.
Thanks, man. Thanks.
What percentage of miners' operating costs, including electricity costs, pool fees, and overhead, but excluding depreciation, are variable costs versus fixed costs? From anonymous attendee.
Sorry, what's the question?
What percentage of miners' operating costs are variable costs versus fixed costs?
I'd say probably 80%. Well, you have your initial deployment, and that's probably, so fixed cost could be your facility as well as your machines. The operating cost moving forward is predominantly just electricity. So if you were deploying 10 million, probably 80% is going to go to mining rigs, 20% is going to go to the facility. You start generating your Bitcoin, and of that Bitcoin, probably 20% is 30% maybe is going to be operating expenditure. So if your margins, if you deploy 10 million and that yields probably 16 million in the year, I would say 40% of that is going to be operating expense. So you're looking at 6.4 million. 6.4 million being operating expense on. So 64% of the initial principal is probably going to be operating expense, but that's generated throughout the year. Your initial deployment, you're probably spending 80% on mining rigs, 20% on facility build out, and then you'll probably yield maybe 16, 18 million throughout the year. Of that, 30 or 40% is going to be OpEx. 60% is going to be revenue. So.
Well, I know some of our panelists have other engagements, so we're going to start wrapping up right now. Final thoughts from everyone. We'll be sure to get back together post halving for a little pulse check, make sure everyone's doing all right. But if everyone wants to go through, give any final thoughts.
Thanks, guys, for the call. Thanks, Matt, for organizing this, and Blockware Solutions. Appreciate it.
Absolutely.
Yeah, thanks for organizing. I've seen a few questions come up about people asking about financing. Feel free to email credit@arctos.capital if you have any questions, and we can take a look and chat from there. But great to be involved.
Thanks for participating, Trevor.
Yeah, thanks for having me. And I mean, the ecosystem is fascinating. It's growing rapidly. It's really fun to watch. Very bullish going forwards the next 4 years on Bitcoin mining in general.
Cheers.
Yeah.
Thanks, Blockware guys, for setting this up. And Josh at Navier.com if I can help answer any questions. Thanks.
Yeah. Thanks a lot, guys. And I think hopefully we'll have a quarantine over soon and we'll meet in person again.
Yep.
Oh, totally.
All right, guys. Thanks so much. 10 days, 10 or 11 days till the halving. It's exciting times. So cheers to that, right?
Yeah.
Cheers.
Later, gentlemen. Thanks for joining.
Okay.
Thanks, guys.
Take care, guys. Thank you.
Take care. Bye-bye.